Have the stars finally aligned for America's first interest rate cut in more than 4 years? If so, what do analysts think it will mean for precious metals? Before we begin, remember to like this video and subscribe for more economic updates. Last week, we learned the nation's headline inflation number declined. It is the first time in more than 4 years that monthly CPI actually fell. Some experts say it is not only a revealing sign of where interest rates could be headed, but a sign that a boost for precious metals could be on the way. There's been a great deal of chatter about the impressive resilience that precious metals have displayed so far this year. From the beginning of January through the end of last week, gold appreciated 17% to more than $2,400 per ounce, and silver had climbed nearly 30% to slightly more than $31 per ounce. Part of what makes these results so notable is that they've been achieved despite the fact that interest rates soared in 2022 and 2023 to the target rate of 5.25% to 5.5%, the highest level in 23 years. Restrictive rate environments tend to be hostile for assets such as precious metals. However, gold and silver have managed to outperform some of the most popular mainstream assets and indexes over the last 2.5 years. Numerous analysts say a climate of heightened economic and geopolitical uncertainty has gone a long way to helping metals offset the challenging rate environment. This is especially true with so many of the world's central banks buying record quantities of gold since 2022. The CPI numbers might be the sign that Fed officials have been seeking to pivot to lower interest rates. Not only did headline CPI outright decline by 1/10 of a point month over month in June, but annual core CPI decelerated to 3%, its lowest level in more than 3 years. Austin Goolsbee, president of the Federal Reserve Bank of Chicago, referred to the June CPI report as, quote, profoundly encouraging, and said, "I think this is what the path to 2% looks like." More good news for the near-term prospects of lower interest rates came last week in the form of Fed Chair Powell's semi-annual monetary policy report to Congress, making what the Wall Street Journal described as a, quote, subtle but important shift that moved the central bank closer to lowering interest rates. Powell's testimony focused more on the potential risks that stem from keeping rates elevated. Elevated inflation is not the only risk we face, Powell told the Senate Banking Committee last Tuesday. During the same appearance, the chair said directly that cutting rates too late or too little could unduly weaken economic activity and employment. On that note, the government's official unemployment rate has risen the last 3 straight months and now sits at 4.1%, its highest level in 2.5 years. Declining inflation, rising unemployment, and a central bank that is showing signs that it could be ready to address both with rate cuts is music in the ears to gold bulls. Given the overall trajectory of monetary policy and gold demand, I think the bull run is not over yet, said Zain Vauda, market analyst at Market Pulse. Analysts at TD Securities suggested, since it looks like the official sector is still interested in using gold to diversify their FX reserves, more uptake from investors when the timing of rate cuts become more predictable should see gold rally to new records. We have been reporting to you month after month, video after video, of gold strength during economic headwinds, of high interest rates and tight fiscal policy. The underlying reasons have three components: geopolitical tensions, fiscal instability, and economic uncertainty. These drivers have not changed. Now imagine economic headwinds changing to tailwinds of low interest rates and looser monetary policy. What do you think gold and silver will do then? Until next time.